CFA Level 1 Practice Questions. Learning Module. Analyzing Statements of Cash Flows 1. Topic: Linkages between the financial statements. A software company receives an advance payment of $600 from a customer for an annual subscription. At the time of the cash receipt, the immediate impact on the company's financial statements is an A. Increase in revenue of $600 and an increase in operating cash flow of $600. B. Increase in a liability of $600 and an increase in operating cash flow of $600. C. Increase in an asset of $600 and an increase in financing cash flow of $600. Cash received before service delivery creates a liability, unearned revenue, and revenue is deferred until the service is provided. Operating cash flow includes cash from normal business operations like customer payments. A. Incorrect. Revenue recognition error violates accrual accounting principle. C. Incorrect. Cash inflow from customer payments misclassified as financing activity. Topic: The direct method for cash flows from operating activities. A company reported revenue of $80 million and cost of goods sold of $35 million. During the year, accounts receivable decreased by $4 million, inventory increased by $3 million, and accounts payable decreased by $2 million. If the company paid $12 million for salaries and $5 million for interest under U.S. GAAP, its operating cash flow was closest to A. $23 million, B. $27 million, C. $31 million. A manufacturing company reported cost of goods sold of $120 million. During the year, inventory decreased by $8 million and accounts payable increased by $4 million. The cash paid to suppliers during the year was closest to $108 million, B. $116 million, C. $124 million. A company reported cost of goods sold of $200 million. During the year, inventory increased by $15 million and accounts payable decreased by $5 million. The cash paid to suppliers during the year was closest to $180 million, B. $210 million, C. $220 million. A company reported interest expense of $15 million. The beginning balance of interest payable was $4 million, and the ending balance was $6 million. The amount of cash the company paid for interest is closest to A. $13 million, B. $15 million, C. $17 million. A company reported sales of $500 million and cost of goods sold of $300 million. Accounts receivable increased by $15 million. Inventory decreased by $10 million, and accounts payable increased by $5 million. The cash received from customers and cash paid to suppliers, respectively, are closest to E. $485 million and $285 million, B. $485 million and $315 million, C. $515 million and $285 million. A company reported interest expense of $25 million and tax expense of $15 million. During the period, interest payable decreased by $2 million and taxes payable increased by $5 million. The cash paid for interest and taxes was A. $23 million for interest and $20 million for taxes, B. $27 million for interest and $10 million for taxes, C. $27 million for interest and $20 million for taxes. Apex Manufacturing provided these details from its financial records. Cost of goods sold $156,000. Raw materials inventory decreased by $4,200. Finished goods inventory increased by $1,800. Accounts payable to suppliers increased by $3,100. The cash outflow to suppliers is closest to $147,500. B. $150,500. $164,500. A company reported annual revenue of $845 million. The beginning and ending balances of accounts receivable were $95 million and $108 million, respectively. The cash received from customers during the year was closest to A. $832 million. B. $845 million. C. $858 million. When calculating cash paid to suppliers, an increase in inventory combined with a decrease in accounts payable would result in cash paid, that is, A. less than the cost of goods sold. B. equal to the cost of goods sold. C. greater than the cost of goods sold. A retail company reports the following from its financial statements in $ millions. Cost of goods sold $1,550. Beginning inventory $420. Ending inventory $500. Beginning accounts payable $300. Ending accounts payable $275. The cash paid to suppliers is closest to A. $1,545. B. $1,605. C. $1,655. A company reports the following information for the year. Beginning salary and wages payable $45 million. Cash paid to employees $380 million. Ending salary and wages payable $52 million. The salary and wages expense in millions for the year is closest to A. 373, B. 387, C. 427. A retail company's income statement shows net sales of $500 million. The balance sheet reveals accounts receivable of $45 million at the start of the year and $38 million at the end of the year. Based on this information, the cash collected from customers is closest to E. $457 million, B. $493 million, C. $507 million. A company reports cost of goods sold of $720 million. The balance sheet shows inventory was $150 million at the start of the year and $130 million at the end of the year. Accounts payable was $95 million at the start of the year and $110 million at the end of the year. The cash paid to suppliers in $ millions is closest to A. 685, B. 705, C. 735. An analyst gathers the following information in millions about a company. Cost of goods sold $800. Depreciation expense $150. Increase in property, plant, and equipment $300. Change in inventory plus $40. Change in accounts payable negative $15. The amount of cash in millions that the company paid to its suppliers is closest to 745, B. 825, C. 855. A company reports revenue of $500,000 on its income statement for the year. If accounts receivable decreased by $25,000 during the same period, the cash collected from customers was A. $475,000, B. $500,000, C. $525,000. A company reported sales revenue of $150 million for the year. At the beginning of the year, accounts receivable was $35 million, and at the end of the year, it was $42 million. The cash collected from customers during the year was closest to A. $143 million, B. $150 million, C. $157 million. A manufacturing company reported annual revenue of $250 million. If accounts receivable decreased by $15 million during the year, the cash collected from customers was E. $235 million, B. $250 million, C. $265 million. Operating cash flow is calculated as cash receipts minus cash payments. Cash receipts and payments are calculated using revenue. changes in current operating assets, and changes in current operating liabilities. Cash receipts and payments are calculated using revenue. Changes in accounts receivable and deferred revenue, COGS, changes in inventory and accounts payable, and salary and wage expense. Cash payments for operating expenses, interest, and income tax are calculated using specific formulas. Direct method core concept: revenue, COGS, expenses from income statement, adjusted by current operating assets and liabilities. Direct method core concept: cash receipts and payments calculated from income statement, COA, and COL changes. Cash payments equals income statement plus changes from COA minus changes from COL. Cash payment to suppliers equals COGS plus changes in inventory minus changes in accounts payable. Direct method core concept: cash receipts and payments based on income statement changes. Cash payments equals income statement plus changes from COA minus changes from COL. Cash payment to suppliers equals COGS plus changes in inventory minus changes in accounts payable. Cash receipts equals income statement minus changes from COA plus changes from COL. Cash payments equals income statement plus changes from COA minus changes from COL. Cash payments equals income statement plus changes from COA minus changes from COL. Cash payment to interest expense equals interest expense plus none minus changes in interest payable. Cash receipts equals income statement minus changes from COA plus changes from COL. Cash payments equals income statement plus changes from COA minus changes from COL. Cash receipt from customers equals revenue minus changes in account receivable plus changes in deferred revenue. Cash payment to suppliers equals COGS plus changes in inventory minus changes in accounts payable. Direct method core concept: cash receipts and payments based on income statement changes. Cash payment to interest expense equals interest expense minus changes in interest payable. Cash payment to income tax expense equals income tax expense plus changes in deferred tax asset minus changes in income tax payable minus changes in deferred tax liabilities. Net change in inventory equals change in raw materials plus change in finished goods. Cash payment to suppliers equals COGS plus changes in inventory minus changes in accounts payable. Cash receipts and payments are calculated based on changes in COA and COL. Cash receipts from customers equals revenue minus changes in account receivable plus changes in deferred revenue. Cash paid to suppliers exceeds COGS due to increased inventory purchases and decreased accounts payable. A. Incorrect. Increasing inventory and decreasing accounts payable increase cash outflow, making the scenario incorrect. B. Incorrect. Changes in inventory and accounts payable affect cash outflow, making the initial option incorrect. Changes in inventory equals ending inventory minus beginning inventory. Changes in accounts payable equals ending accounts payable minus beginning accounts payable. Cash payments to supplier equals COGS plus changes in inventory minus changes in account payable. Changes in salary and wages payable equals ending salary, and wages payable minus beginning salary and wages payable. Cash payment to employees equals salary and wages expense minus changes in salary and wages payable. Cash receipt from customers equals revenue minus changes in account receivable plus changes in deferred revenue. Cash payment to suppliers equals COGS plus changes in inventory minus changes in account payable. Cash payment to suppliers equals COGS plus changes in inventory minus changes in account payable. Cash collected from customers is calculated by adjusting accrual-based revenue for changes in accounts receivable. A decrease in AR indicates cash collection from prior sales, increasing cash collected. A. Incorrect. Our decrease incorrectly subtracted from revenue. Adjustment only valid for AR increases. B. Incorrect. Ignores AR change, assuming revenue equals cash collected. Cash collected from customers equals sales revenue minus increase in accounts receivable. Or alternatively, cash collected equals sales revenue plus beginning AR minus ending AR. Cash collected from customers equals sales revenue minus increase in AR. Cash collected equals revenue minus accounts receivable. Decrease in accounts receivable indicates cash collection and reconciles accrual-based revenue.